Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We are well aware of how markets reacted to Beijing's move on export controls for rare earth minerals. Well, political leaders are taking notice as well. Today, on the sidelines of the meetings of the IMF and World Bank, Japan's finance minister voiced serious concern, and he stressed the importance of coordinated action from G7 nations to avert a negative impact on global supply chains. For a look now at Japan and how it's being impacted by the U.S.-China trade war, I'm joined by Shuntaro Takeuchi, who is portfolio manager at Matthews Asia. Shuntaro joins us from San Francisco. Thank you for making time to chat with me. Let's begin with a little bit of exploration here as to how Japan is being caught up in the U.S.-China trade war. Can you give me some perspective?
Sure. So with regards to the tensions between U.S. and China, unfortunately, the new reality is that the one way of globalization is at least slowing, if not reversing, meaning that the capital expenditure of manufacturing activity across the world would be inefficient than before. You can no longer make everything at one area and export it globally. In that way, I think we believe that Japanese manufacturers will actually benefit from that increase of capital expenditure coming from, I would say, less efficient capex spending.
So I want to change gears because we're hearing that the Trump administration is poised to ease some tariffs on the U.S. auto industry. We are being told that the Commerce Department is set to announce a 5-year extension. This would allow automakers to reduce what they pay in tariffs on imported car parts. Now, we both know that the Trump administration has been in the process of redefining U.S. trade relations, largely through the use of tariffs. And Japan has clearly been impacted a great deal. Steel, yes, but particularly autos. Give me your sense of what's going on the ground in Japan as it relates to U.S. trade policy, especially for the car makers.
Yes, I think regarding U.S. and Japan, the single most important industry for the Japanese export sector is in autos, given that how many people are actually employed in Japan. And encouragingly, that Japan and the U.S. has reached a deal with regards to the tariff rates. And also another thing that is benefiting for the Japanese automakers is they are actually increasing market share as a result of that, given their efficiency in their hybrid technologies.
Let's pivot to monetary policy in Japan. Governor Ueda has indicated that the BOJ will continue to tighten if the BOJ has confidence in achieving its economic outlook. Now, we know that inflation is obviously a big problem now, and I'm curious to get the House view at Matthews Asia when it comes to predicting the next step for the BOJ.
Yes. So our base scenario is a 25 basis point raise sometime late this year or early next year, and then put on hold for at 75 basis points for a while. The reason why I say this is there are shoots of real wage growth happening in the larger corporate space. Hopefully that will trickle down to the SME, which is 99% of all the corporates in Japan. And Governor Ueda is really looking at the real wage growth to happen to have a sustained pace of raising rates. But basically, our case is a 25 basis points and put on hold for the time being.
So how do you expect the market to continue performing? I mean, the equity market in Japan is very close to record highs. We're not quite there. We're seeing a little bit of weakness, actually, in the Friday morning session. What is your outlook for Japanese equities?
Yes, in the very short term, Japan market is trading at 16 times for 12-month price to earnings, which is in the high end of a 10-year range. It is a fact that some thematic fields such as defense and AI-related names are trading at all-time high valuations. However, mid to long term, we see opportunities for Japan equities as an asset class, mainly because one, nominal GDP growth, which we view as a proxy to domestic top line growth, is starting to gain traction. So Japan lacked meaningful nominal GDP growth for nearly 30 years. And additionally, an adjustment of overly conservative tariff impact of Japanese corporate profit guidance for this year, earnings revisions are starting to improve. And secondly, lower return on equities compared to US and Europe, which have capped Japan valuation levels, is starting to see improvement via a margin improvement as well as better capital allocation policies. Unwinding cross-share holdings have been happening, but still 10% of outstanding is held by the corporates. And by bringing that down towards zero, we'll have meaningful upward pressure in the return on equities, hopefully leading to the valuation expansion. And third, but not least, it is not a crowded trade. Japan, despite its relatively stronger performance, it is still common underweight among global investors, and it's very far from a crowded trade. We don't expect that U.S. exceptionalism to reverse overnight, but we still see a meaningful gap between opportunities that the Japan equities have and investors' real positioning.
Speaking of positioning, maybe we can move into the political environment right now in Japan. There's been a lot of volatility. I think we can agree on that much. Sanae Takaichi appeared as though a couple of weeks ago she was set to become the first female prime minister of Japan. Is that very much in doubt now? Can you give me a sense of what Matthews Asia is expecting on the political front?
Sure. So this past few weeks was full of surprising outcomes. Even like when Takaichi got elected, Koizumi was initially the most favored to win the LDP leader race. But in the end, Takaichi won the runoff in the end. And then Komeii suddenly withdrew from the 26-year outstanding coalition. And this past week has been a scramble of all party leaders meeting each other to secure the majority. And as of today, October 17th morning in Asia, LDP and Japan Innovation Party, Ishin, the second largest opposition party, is currently in talks for a possible coalition alliance. So the possibility of Takaichi becoming prime minister came down after the breakup of LDP Komeii coalition, but came back up given that if LDP Ishin coalitions happen, it will bring the maximum total seats in the lower house to 231, which is only 2 short of majority, and lower house of 120, which is only about 5 shy of majority. But again, nothing is certain until the Diet vote to elect the next prime minister, which is scheduled to be held on 21st of October. So our current view is that LDP Ishin coalition, if that happens, along with a possible collaboration with other parties for selected legislation, will likely involve fiscal expansionary policies, which we view positively from a domestic demand perspective. Ishin has been calling for lower social insurance premium for working generations to boost household income. Some parties are advocating for raising income tax threshold, abolishing provisional gasoline and diesel taxes. So these areas are another areas of possible change. But again, real wage growth is really critical for domestic consumption as well as normalization of BOJ rate policies.
Okay, so that's what your expectations would be for a Prime Minister Takaichi in terms of the domestic economy in Japan. Do you expect, should she become prime minister, that the relationship with the United States would shift in a meaningful way?
Yes. So I think the base case is that U.S. and Japan continues to be an important ally, and they're working together. Takaichi was very close to Prime Minister Abe, whom Abe was very close to President Trump. So I think on a relative basis, I think Japan is in a good situation between the two countries of U.S. and Japan.
Shuntaro, we'll leave it there. Thank you so very much for joining us. Shuntaro Takeuchi, who is portfolio manager at Matthews Asia, joining from San Francisco here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The equity market in the U.S. retreated today on worries over credit quality. We had two regional banks disclosing sizable charge-offs related to alleged fraud. Zions Bancorp and Western Alliance Bancorp both said they were victims of fraud on loans made to fund investments in distressed commercial mortgages. Now, analysts were saying this seems to be kind of an isolated case, nothing here to suggest systemic risk. For a closer look now, I'm joined by Jeff Palma. He is head of multi-asset at Cohen and Steers. Jeff joins us from here in New York City. Thank you so much, sir, for making time to chat with me. Can we begin with the story on credit? Yesterday, we heard from Jamie Dimon, obviously the head of JP Morgan Chase. He seemed to issue this kind of ominous warning about credit risk with some of the high-profile collapses that we have seen, two in particular. Dimon said, when you see one cockroach, there are probably more. What do you think of what he had to say yesterday and what unfolded today?
I think, as you say, Doug, it's an interesting combination, the timing of these things. Jamie Dimon's warning, the First Brands event a couple of weeks ago, and then these today. What's interesting is it comes against a backdrop where, in general, credit markets have been very sanguine, spreads are very tight. People have been very comfortable with how growth has behaved, and default rates have been very, very low. It does seem like it's isolated and idiosyncratic, as they say. But, there have also been signs that the lower end of the consumer spectrum is weak or has been weakening. I think it fits in with some of the narrative about weaker unemployment, weaker employment numbers. And so we'll just sort of have to see how this plays out. I agree so far. It doesn't look systemic, though.
So we had some Fed speak today. Chris Waller, the Fed governor, was saying the policymakers can keep lowering rates in quarter-point increments because the labor market really has been faltering and it needs support. But then we heard from Fed Governor Stephen Miron, and he was advocating for a larger cut. He said this flare-up that we have seen lately in the U.S.-China trade war is created more downside risk for the economy. He wants to see a half-point cut. And then when you put into context what we saw in the regional banks today, I think the KBW Regional Bank Index was down about 6.8%. Do we need to consider the fact not only that the Fed is going to continue to ease, but we may need a larger rate cut?
Yeah, well, this is the tension that's happening within the Fed. I mean, Stephen Miron now in his short tenure has made it very clear that he thinks rates need to be substantially lower. Most of the rest of the board thinks that rates only need to be, lowered gradually. By the way, some, as we saw in the last dot plot, don't think rates need to be lowered at all, maybe even need to go higher at some point. And, it sort of gets to the current situation in the economy. Some call it the K-shaped economy, right? Where parts of the economy are doing really well. That would be high-end consumers and things buoyed by CapEx spending. And then there's everything else, which is really struggling. And it's pretty clear that the employment backdrop has been weakening. And it doesn't help. The tariff news in general is pretty negative for the employment backdrop. You put that on the other side, on one hand, and on the other hand, inflation hasn't moderated and, in fact, seems pretty sticky. So our own view is that you get a couple of rate cuts, but that might be it, barring any much deeper weakness in the economy.
So what do you make of the behavior of the bond market? We had yields at the short end. I'm looking at the 2-year that was down about 8 basis points or so in New York, the lowest, I think, since around 2022. How do you evaluate the price action in the bond market?
It's a big move, and it's certainly consistent with a view that bond markets are pushing for more rate cuts, right? Certainly more aggressively than that narrative that I just talked about from our side, and same from Waller's view. It seems to push more towards people getting concerned about growth. What's odd about it for me is if you really believe a weak growth backdrop, you would expect equities to be a bit weaker. Now, maybe if financials are starting to tell that story, you're seeing some of it, but you're certainly not seeing it more broadly within risk asset markets.
The other thing that we've been dealing with here in terms of market action, the concern about more tension in the U.S.-China trade relation. Today, as part of the World Bank, IMF meetings that are going on in Washington, we heard from Japan's finance minister. He seemed to voice a lot of concern here, serious concern over China's latest export controls when it comes to rare earth elements. And he said that really it's important now for some type of coordinated action from G7 nations to avert any type of negative impact that this may have on global supply chains. So it's not just from the U.S. side. Other countries are beginning to express concern about the way in which China is dealing with the United States and how that may impact other countries and other markets. Are we perhaps flirting with something that could turn a lot more serious?
My sense here is that it's more likely people kind of laying out very wide, if you like, bid-ask in terms of a negotiation policy, right? President Trump is kind of laying one side of very aggressive tariffs, potentially 100%, which is highly, highly unlikely. And equally on the other side, I think China is trying to play its card, which it views very strongly as being rare earths. I think, and this would just sort of, kind of lead us likely towards something more moderate, something in the middle, because I think it doesn't really, as you say, suit anybody, including not just the U.S. and China, but kind of the broader world economy, to have a kind of a massive flare-up that results in kind of a full meltdown of global trade.
So obviously, rare earths are critical when you look at semiconductor production. We had some pretty strong numbers from TSMC overnight. Revenue guidance was also increased a bit. And the day before, ASML, the Dutch chip-making equipment firm, reported its highest bookings for its cutting-edge extreme ultraviolet tools since the fourth quarter of 23. So there seems to be a lot of positivity still around the AI trade. How do you feel about this right now? Are we late stage, or is there still a lot more in the way of upside?
Yeah, there's clearly a lot of momentum there, as I mentioned before. There, that's been a key underpinning of growth here in the U.S. My best sense here is that there's good visibility for CapEx in the AI trade generally. Certainly for the next year, maybe even beyond that. The good news is there's still a lot of cash funded CapEx, right? So it's all being funded or largely being funded out of free cash flow. And we're still seeing great growth. We're still seeing people be quite positive about the outlook for revenue generation to kind of follow. I think where the questions start to play out over the next 12 to 24 months is, one, do we get the revenue handoff to help protect free cash flow? Do we need to start seeing, companies issue debt? We've only seen very, very small pieces of that. And ultimately, can there be kind of profitability that comes from it? So I think it's too soon to completely freak out about it, but there's enough questions on the horizon, to kind of keep an eye on exactly how it would all play out.
Which makes this rally that we have seen in gold all the more interesting. You'd think that this is some type of haven, right? Given a lot of the risk that may be on the horizon. We broke above in the spot price in New York, trading $4,300 an ounce. So we're clearly at records. What does this mean to you?
Gold's been amazing, and equally so has silver. They've certainly kind of, but as you say, it's sort of, if you view it through the lens of a risk trade, it's sort of inconsistent with what we're seeing in other markets. I think there's a couple of different avenues, though. One is the dollar has definitely been weaker this year. And I think in general, and when you kind of link this to some of the China questions, there's definitely questions about reserve currency status and the strength of kind of broad fiat currencies. And I think that's helping to support gold. Central bank reserves of gold have certainly increased. And so that's probably a piece as well. And then the other piece is that, as I said before, inflation's been a little bit sticky. We're not getting down towards the Fed's target of 2%. And our view is that we're not going to. We're going to hang closer to 3% going forward. And so maybe there's a little bit of kind of an inflation element under the hood there as well. I don't think that independently any one of those things helps to fully explain the move that we've seen in precious metals, but maybe collectively it helps to explain the direction of travel.
So we had the Russell 2000 down about 2% today, maybe some concern about the strength of the economy. Before I let you go, are we flirting with a recession potentially?
So we don't think so. We think that the economy is going to remain fairly resilient. But, there is definitely this case that, the stool that we've been, supporting the economy with is really kind of two legs. It's this one of, some consumers and some CapEx. I think what we really need to see is that support broadens out over the course of the next year. That is some of the objective of lower interest rates. It's some of the objective of some easier fiscal policy. Keep in mind, we are going to get some fiscal stimulus through the bill that was passed earlier this year, the budget bill that was passed earlier this year. Those sorts of things should help the underlying economy. But if you kind of bring this conversation full circle, if there are some underlying concerns about trade and employment and credit, those would probably be the areas that cause things to slow down more quickly.
Okay, Jeff, we'll leave it there. Thanks so much. Always a pleasure. Jeff Palma is head of multi-asset at Cohen & Steers, joining us from here in New York City on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.